All right, welcome back. I appreciate you all taking the time to join me today. We are now in the second week of our 16-week course together, which is Principles of Accounting 1. Happy to have all of you with us, and thank you so much for that first week together. I know that it's not always easy, especially when we have new technologies that you may not be used to, like LinkedIn Learning and how the discussion forums are set up and that kind of stuff. Sometimes it can be real foreign. And so I appreciate you going through the process with me and trying something new. As we expand our minds, as we expand our horizons, trying new things like new technologies, like LinkedIn Learning and artificial intelligence and all of those kinds of things, they really do help your skills. That being able to navigate technical challenges like using new software really helps to enhance your skill set. And so I sincerely thank all of you for going through that challenge, that exercise with us. So, a couple of things I want you to keep in mind because you will have more opportunities for LinkedIn Learning in this course, as you'll find out. So, I want to just kind of show you what the LinkedIn Learning should look like and walk through that process just one more time with you. I know that we talked about it last week, but I just want to kind of emphasize that the importance of understanding how LinkedIn Learning works and why it works the way that it does. So the number one thing, and this came up a few times, is it does not work with Safari. Okay, so if you have a Mac computer, sorry, it's not going to work with Safari. You need to use either Microsoft Edge or Microsoft Chrome. I'm sorry, Microsoft Edge or Chrome. I personally use Edge just because it works with pretty much everything. Um, Sometimes I use Chrome. One of those two are the best. You could also use Firefox, but again, just personal preference. I like Edge. It's good stuff. Um, so you download either Edge or Chrome or whatever. They're both built off of the same open platform technology. Uh, and then the first thing you want to do is set up your account, which I know that all of you have done. But if for whatever reason you haven't already, the way to do that is you go to Start here, and then you come down to the LinkedIn Learning activation instructions, and you can watch the video or follow along using the PDF. There's 9 steps that you need to take in order to connect your UDC account with LinkedIn Learning. Now, once you've followed those 9 steps, you have to do that first before going into the LinkedIn Learning. So once you've done that and everything seems to be connected, you'll come down to that week where the LinkedIn Learning exists. It'll be under Engage and Explore, and then you'll select the this part, and then it should open up, and it should play just like this. And you'll go through all of these videos. Once you've watched all the videos, a green check mark will appear next to all of them. And then at the very end, after the conclusion, you'll be able to find your certificate. Now remember, you have to watch them all in sequence, and there has to be a green check mark next to all of them, which indicates that you've watched it in its entirety. Each LinkedIn Learning certificate takes about 2 hours roughly to get through all of the videos. Some of them will have quizzes embedded in them, like the Next Excel version has a couple of quizzes embedded. I'm going to show you what that looks like. But this just kind of helps you to understand how that process works. Now, when you get to the end, and this is where some of you had some trouble, let's say here I am, and this is an Excel for Accounting. This is one of the certificates in this course. I've watched all of the videos. You'll notice there's a couple of quizzes in here, and I'll show you what those look like here in a second. But you get through all of those. You take the quizzes. They're relatively short. You get to the very end. Ability to take control. As it plays out, at the end of the video, it'll come up like this. It'll say congratulations, it'll have your name, and then it'll say add to LinkedIn profile, download certificate. Those are your options. Okay. Now, what do you need to do for this course? In order for you to get credit in Blackboard, you need to click download certificate. Download certificate, you'll notice at the very top, it'll say LinkedIn Learning Certificate. You click on that, and then you click download PDF only. Once you do that, it shows up in your downloads. You'll come back to the classroom. You'll go to the Dropbox. I call it a Dropbox. I think it's kind of called the Dropbox. And you'll upload it here. Obviously, this looks different than what you see, but there's a spot for you to upload the document there, and that is the process for you to upload the LinkedIn Learning Certificate. Questions on that? Any questions on that at all? Hopefully that helped to clarify some of the confusion. I'm sorry that we didn't go through that last week, but any does that make sense? Yes, hopefully. All right. Great. Again, if you have questions on it, you need help with it, just let me know. I'll walk you through the process. But that's the process in a very general sense. And as I mentioned, there's a couple of opportunities for LinkedIn Learning. And the majority of these LinkedIn Learning certificates are based on Excel. And the reason why we learn Excel is because it's multifaceted. Number one, the majority of employers require you to know how to use Excel. That's just the way that business works. We use Excel for a lot of different things in business, as you know, and accounting is one of them. And so that's why using Excel for accounting is important, because it helps you to analyze the financial health of an organization. You can generate financial statements using Excel, etc. Some employers use it for that very reason. We call it pro forma, which is an opportunity for you to create financial statements using Excel in order to test theory on them. And so that's the overall arching reason why we use Excel in accounting. And so you'll also notice that under Engage and Explore for each week, we have the Excel exercises. You don't submit those exercises. The exercises are just for your practice, okay? There's no place for you to submit those. They don't need to be submitted anywhere. So don't submit those. They're not to be submitted. So that's just, again, Excel exercises are just for your practice. The Excel Essential Training, LinkedIn Learning, that you do submit, and you'll follow the steps that I just showed you to do that. So that's that process. Okay, thank you so much. Apologize about the rant. I just wanted to make sure that we're all very clear on that process, and hopefully that helps you to kind of understand the logic behind it. So here we are. We're in week 2 already, believe it or not. Today's the 16th, so we're in the second day of week 2. So one thing I want you to do is log into Blackboard, open up week 2, and start looking through the material. So here we are, week at a glance. In this week, we're going to be talking about transactions, how the transactions are recorded, and what the impacts are on the financial statements. Okay, that's what week 2 is going to be about. You'll need to read the week 2, chapter 2, go through the PowerPoint presentation that we're about to cover today, and there is a discussion forum for this week. Now, you might be asking, Dr. B, this is kind of an in-person class. Why do we have discussion boards? Discussion boards are a really great opportunity for you to engage with your classmates in a written forum. It also helps you to improve your writing abilities, research abilities, and all of those things. So please take full advantage of the writing discussion forums. And so for this week, we have a discussion forum, which is called Week 2 discussion. And here you will be selecting two of these two above to discuss, and you'll answer these 4 questions. And Maria started us off. Maria did a great job in this. She selected 2 of those learning objectives from this list of 5, and she answered these 4 questions. And so that's what I'm looking for you to do in that discussion forum. Okay. You'll notice the requirements, right? So around 150 words. I don't count all the words. I'm just really looking for substance. Yeah. And then 2 responses to classmates, about 100 words each. That's what makes a really good discussion possible, is that we're discussing, we're having a conversation, and that conversation involves your original post and responding to classmates. That's what a discussion is, right? So that's why we design it that way. Oh, and great job on the references, Maria. This is good stuff. So it's just a matter of doing a little bit of research. Yeah. So use your textbook, but also feel free to use the internet. I mean, it's a big place. So great job on that. And then so that'll be the discussion. And then of course there's the chapter 2 quiz. So let's go ahead and jump into chapter 2 and talk about transactions, how to analyze and record them, which is what this week is all about. Let me just fix this. Sorry. Okay, and let's go ahead and get started. Okay, so I'm going to walk through the process of what a transaction is, how do we analyze it, how do we record it. And then at the end, I'll have 2 ratios for you. A transaction, as you know from our discussion last week, is an exchange. Okay, it's either an exchange for goods and services, and there's usually cash or some type of payment involved, right? That's a transaction in its simplest form. Okay. For example, you purchased gasoline today for your vehicle. Okay, so that was a transaction. You drove to the gas station, you pumped the gas, you paid for the gas. You received gasoline, the gas station received cash or payment. Yeah. That's a transaction. Another example of a transaction, you went to Macy's and you purchased a red t-shirt. Cool. Okay. That was a transaction. You received the t-shirt, Macy's received the cash, the payment, right? That's a very simple transaction. A transaction is what we would call an economic event. Yeah. It's an exchange of goods and services. Yep. So there's a couple of pieces of information that we as accountants look at in order to understand what occurred in this transaction. We look at things called source documents. A source document involves things like a purchase order, a packing slip, a check, a copy of a check, a receipt. Those are what we call source documents. They're original documentation that is related to a transaction. It tells us that a transaction occurred. So the first thing we do is we find those source documents. And then we analyze the transaction and the effects on the accounting equation. Last week you learned that the accounting equation is assets, which is what the company owns, equals liabilities, which is what the company owes to someone else, plus equity, which is what the owners own. That's the basic accounting equation. Assets equals liabilities plus equity. Equity, of course, we expand out to include revenue minus expenses, you know, plus minus withdrawals plus contributions. So we expanded out. But that's the basic accounting equation. Every transaction affects the the accounting equation. And the way that it does that is there is a debit and a credit. There are two accounts being affected in a transaction. Okay? And each account is tied to either an asset, a liability, or equity type of account. Okay? The accounting equation, as we learned last week, always maintains its balance. So I'm going to talk about it in further detail, elaborating more on what we learned last week, is how transactions affect the accounting equation. These transactions get recorded in what we call a general journal, also known as a ledger. These general journal gets posted to what we call ledger accounts. The transaction gets recorded in this general journal. There's a debit and a credit, and it's in balance, and it gets posted what we call a ledger account. A ledger account is a list of all the different accounts and their balances. Okay, think of it like the balance sheet, for example. But a ledger account is a list of all the transactions and all the respective balances. That's what we call a ledger account. At the end of the month or the year, we take all this information, all this data from all of the transactions that occurred during that month or that year, and we prepare the financial statements, the income statement, balance sheet, statement of cash flows, statement of retained earnings. We prepare those financial statements based off of all of those transactions. And so I'm going to show you today what this process looks like and how it works and why we do it this way. So, as I had earlier mentioned, source documents are original documents used to identify the transaction and how and why it happened. Examples would be like a bill from a supplier, the receipts, checks, purchase orders, payroll records, bank statements. These are all what we call source documents. They help us to identify transactions. And those transactions, we find out the date that they occurred on, who the payee was, or who we paid something to, or what we received, who we received it from. We also find out the amount, and all that information from these source documents helps us to determine the transaction. It helps us to analyze the transaction. So we take the information from these source documents to find out about all the transactions that have occurred. For each transaction, we go through a process of recording them. As we record the transactions, we record them to what we call accounts. An account is an increase or a decrease to an asset, liability, equity, revenue, or expense. An example of an account would be cash. Cash is its own account. Okay. Another example of an account will be accounts receivable. An account could be considered inventory. Another name of an account would be property. Another account name would be plant. Another account name would be equipment. Those are all asset accounts. Mohammed, I see your hand up, please.
Yeah, I have a very important question, please, Professor.
Sure,
So,
yes.
uh, I don't know what is the difference between the accounts receivable and the notes receivable, and the
Yeah,
difference between the accounts payable and the notes payable.
Great. Yeah. Thank you so much for your question. So, excellent question, Mohammed. So, here's the difference. An account receivable is when a customer made a purchase from the business and the customer has not yet paid the business. That creates what we call an account receivable for the business. The transaction has occurred. The customer received the good or the service, but they have not yet paid the business. And so what that does, Mohammed, is it creates what we call an account receivable for that customer. The business expects to receive the payment from that customer in the future. That is what we call an account receivable. The business expects to receive money from that account in the future. That's why the name is accounts receivable. And there could be multiple customers that owe the business money that have not yet paid. So that's multiple accounts receivable. We expect to receive payment from our customers in the future. Okay, so we, the business, made a sale to the customer. The customer has not yet paid us. They'll pay us in the future, 30 days from now. Okay, so we create what's called an account receivable for the customer. Customer is expected to pay us in the 30 days from now. They pay us, then we reduce their account receivable. You see, so that's an account receivable. The other,
What about the notes receivable?
yep, great. So a note receivable, excellent question, is when, let's say we had a customer that did not pay us. Okay, they have an account receivable with us. Several months went by and they never paid us. Okay, that happens. That happens in business. So we reach out to the customer and we say, "Hey, customer, you haven't paid us in 3 months. We're going to convert your account receivable into what we call a note receivable." And what that does, Mohammed, is that typically involves interest. So because the customer hasn't paid us in 90 days, we converted their account receivable to a note receivable, and now we're charging the customer interest as well because it's super late. And so that's what a note receivable is. It's the conversion of an account receivable into a note receivable when it's like really far past due. That's one example of a note receivable. Another example would be, Mohammed, is we made an agreement with that customer beforehand, before they made the purchases. We said, hey, make as many purchases as you want. You have up to this amount, which is your note. And we expect you to pay us the note plus interest. Okay. It's kind of like giving a customer a loan. That's how you would describe a note receivable. So hopefully that helps to clarify your question. Now, Mohammed, you also asked about what is accounts payable and notes payable.
Exactly. Mhm.
An account payable is when we, the business, received a bill from our vendor, or maybe we received a bill from the electric company, Pepco, or we received a bill from the water company, or we received a bill for rent, or whatever, right? The company receives the bill, but we have not yet paid it. Okay? Therefore, it becomes what we call an account payable. I received the bill for my electric bill, my Pepco bill. Okay? And I have 30 days to pay it. So I received the bill, I entered it into my QuickBooks or into my accounting system, and it has a date that I need to pay it by. When I do
Yeah, it's
that,
something like a company debit, something like this.
yeah, so the way to think about this, Mohammed, is you know you receive a bill, okay, for whatever reason. It could be an electric bill. It could be a water bill. It could be a bill from your vendors, because
Mm.
you purchase inventory, but you haven't paid them yet. Anytime that you receive a bill and have not yet paid it, it's called an account payable. You owe that money within a year or less. Typically it's like 30 days or whatever, but it that's what an account payable is. It's a bill, the company received it, we haven't paid it yet. That's an account payable. Okay. The other question you had was notes payable. A note payable is a loan. Okay, you might have a personal loan, a bank loan, uh, a mortgage, a card loan. That's note payable. It's a loan. The company took out a loan for whatever reason, and we make monthly payments. That's what we call note payable. It's long term. Excellent questions. Very good questions. Yeah, and all of these are representative of accounts, right? So, yeah, very great questions. Absolutely. So Mohammed, the accounts receivable and the notes receivable, those are asset accounts. The reason why those are asset accounts is because we expect that our customer is going to pay us. We have a claim to that payment. And when the
Mhm.
business has a claim to a payment, that's an asset to the business. We expect to receive cash from our customer. That's an asset. Okay. So that's why accounts receivable and notes receivable are assets to the business.
But the notes payable and the accounts payable
Are
is
liabilities.
considered as a liabilities. Yeah,
Yes,
exactly.
exactly. And the reason why they're liabilities is because we received the bill, but we haven't paid it yet. And when you owe someone something to someone else, that's a liability. Yep, very good. Yeah, great questions. So yeah, those are great examples of accounts. And those, so when we make those payments, we record those payments, or when we receive payments, or paying bills, whatever, we record
Mhm.
those transactions to our what we call the general ledger, which is a record of all of the accounts and their balances. Yeah. I'm going to show you what all this looks like. Yeah, very, very great comments, great questions.
Thank you so much, Professor.
It's
That
my
was
pleasure.
very awesome from you.
Awesome. My pleasure. Yep.
Thank you.
Great. So just as Muhammad and I were just talking about, classic example of assets are cash, inventory, property, plant, and equipment, accounts receivable, notes receivable, supplies, which are used in like a process. Yeah. Uh, and you'll also see, here's another one, prepaid accounts. Prepaid accounts. Here's my example of a prepaid account. A prepaid account is when the business prepays an expense. All right. The best example I could give you is insurance. Uh, Even in your personal life, you might do this. I personally do this. So every year, I prepay my insurance for my car for the year. Okay. I pay it up front. Yeah, it's a larger amount of cash up front, but usually you get like a discount or whatever because you paid the whole amount for the whole year. Yeah, we call that prepaid. I prepaid the expense. So here's how it works. Here's my example. Let's say the business insurance is $1,200 for the year. Okay, great. So on January 1, I wrote a check to the insurance company for $1,200. It covers the entire 12 months. Okay, that's called prepaying. Why is it called prepaying? Because I paid in advance of the expense actually being incurred. Okay, I prepaid the whole 12 months in advance. Now, why is that an asset, you might be wondering? That's because I can decide hey, you know what? Let's cancel that policy. The insurance company has to pay me back, right? I'm entitled to what I had prepaid. I prepaid it. If I decide to cancel it, they have to give it back to me. That's why it's an asset. Okay, that's why prepaid accounts as an asset. We're going to talk more about that in the very near future. So those are asset
So,
accounts. It's what the
Professor,
business owns. Yes, please, Marlon.
so essentially, a prepaid account is money that you pay in advance, but if you decide to cancel it, it's yours, and it's an asset because technically you still own it
You got it. That's
because it
100%
hasn't
correct.
expired yet.
Yeah, that's right. Exactly. And so Marlon, to continue with that train of thought. So let's say, uh, you know, I prepaid the insurance for the 12 months, right? 1,200 bucks covers a year, so that's $100 a month, right? 12 months a year. So, $100 a month, it would be my insurance expense. Let's say we get to February. Okay, February 1 rolls around. If I decide to cancel, they're going to give me back $1,100, right? Because I already used 1 month, right? The month of January. Uh, so yeah, that's exactly why it's called a prepaid. A prepaid account is technically an asset because I would be entitled to that whatever I didn't use, basically. Yeah, excellent question. So then we have on the other side of the accounting equation, we have liabilities and equity. Liabilities, as we discussed earlier, is what the company owes. Okay, accounts payable. Those are bills that the company received. We have not yet paid them. Okay. Notes payable. The company took out some loans for whatever reason, a mortgage, vehicle loan, um, other long term loans. Now, here's the difference accounts payable, that's what we call short term. Short term is anything less than 1 year. Anything less than 1 year is called short term or current. Current or short term, they mean the same thing. Okay? Less than 1 year. If it's greater than 1 year, it's called long term. Greater than 1 year, it's called long term. Right? A note payable is long term. In other words, I took out a mortgage, okay, 30 years, 15 years, 10 years, whatever. I took out a car loan, 5 years, whatever. I took out a personal loan, 3 years. Okay. Those long term loans are called notes payable. Okay. Then you'll see these two other counts. One's called accrued liabilities. Let me explain accrued liabilities. Accrued liabilities would be something like payroll. Okay? My employees work in my company and I pay them every 2 weeks, we'll say. Okay, that's probably the average. So I pay my employees every 2 weeks. They accrue payroll expense. Okay. Every hour that my employees work, they accrue wages. Accrue wages. Okay. So let's say you earn $20 an hour, you work for 40 hours a week, and you get paid every other week. All right. So you work your um, normal shift, normal shifts or whatever. You work your 40 hours a week. We pay you every 2 weeks. So we pay you for 80 hours in every paycheck. Okay. They're accruing their wages. Uh, and so that's what an example of an accrued liability. Jonathan, I see your question. Would a service contract be considered a notes payable? It depends on the length of the contract. If the contract is greater than 1 year, yes. If it's less than 1 year, no. Great question. And it also depends on what the service contract is for, because sometimes, and it depends on what it is. If it's a lease or something, it's just an expense. Yeah. It, there's some accounting rules around service contracts, but that's a great question. The last liability I want to talk to you about is called unearned revenue. I touched very briefly on this last week. Unearned revenue is when a customer pays the company in advance of receiving the good or the service. Okay, I got a great example for you. Since it's winter, it just snowed. There's a lot of plows on the roads. Yeah. So let's say you have a house and you contacted a plow service, and they said, "Hey, you know what? Make a contract with you. We'll say we'll plow your driveway, uh, but you have to pay us up front for the season." Okay. Okay, great. So the customer pays the plow company up front for the season. The company records that as what we call unearned revenue. And the reason for that is because the company did not yet provide the service. When the company provides the service, then it becomes revenue. Okay? It's unearned revenue when the customer pays but has not yet received the good of the service. Okay? Unearned revenue. The reason why it's a liability, a couple of reasons here. Because, number one, the company didn't provide the good of the service yet, so therefore it's unearned. And it's a liability because the customer can ask for a refund, before the good of the service is provided. Yeah? Technically, that money don't belong to the company until it becomes earned. You see? So that's why it's a liability, unearned revenue. Okay, so moving on to equity. Equity accounts, there's 4 primary equity accounts. There's owner's capital. Owner's capital is when the owner of the company invests money into the business. When the owner invests money into the business, money, property, plant, and equipment into the business. Okay, that's what we call owner's capital. The owner is providing capital to the business. Owner's capital. That's where the name comes from. The other one I want to touch on is what's called owner's withdrawals. As an owner of a company, I have the ability to take money out of the company. Right? It's my company. Well, I'll take money out of it. Okay? Owner's withdrawal. The owner's taking money out of the business for whatever reason, personal use, whatever. That we call that an owner's withdrawal, and it affects equity. It affects their equity. And then, of course, we have revenue. Revenue is sales. Revenue is sales. That's what revenue is. Revenue is sales. It's the amount that I've sold. Okay, the amount of money that I've sold. The value of the inventory that I sold. Revenue. And then we have expenses. These are day-to-day operating expenses of the business. Be things like rent expense. There's a laundry list of different kinds of expenses. Supplies expense, office supplies expense, repairs and maintenance expense, you name it. Right? There's a whole ton of types of expenses in business, but those are the basic accounts that's also I explained to you what each one of them are, basically how they work. Yep. Okay, so breaking it down just a little bit further, and we talked about all of these, but uh, again, asset accounts, it's what the business owns. Okay, property, plant, and equipment, prepaid accounts, accounts receivable, notes receivable, cash, supplies. Yeah. These are all assets to the business. Now, the other reason why we call these assets, they're assets because these things help the business to generate sales, right? These things help the company to generate sales. That's why we have them. The business has equipment to create the products, and they do it in a building, probably a warehouse. And that building is on land. Okay. These things help the company to generate sales. The company uses cash to purchase things like inventory, also known as supplies, to generate sales. The company uses cash for other things, but primarily to operate the business, to help the business to generate sales. Accounts receivable, as a result from sales. Note receivable, result from sales. Prepaid accounts, the company has the claim to what they paid in advance and can use that money to generate sales. So, asset accounts are typically designed to help the company to generate sales. It's what the business owns. Those are asset accounts. It does go deeper than this. Yeah, there's a lot of other asset accounts, but these are the most basic ones that almost every business has, typically. When it comes to liabilities, it's what the business owes to someone else. Accounts payable, those are bills the company received, has not yet paid them. Notes payable, those are loans, like, a mortgage, car payment, whatever, long-term stuff. Accrued liabilities, those are things like wages payable. Yeah, we call those wages payable. When an employee works for you, you haven't paid that employee yet. That's called wages payable. That's an accrued liability. Other accrued liabilities include things like um, benefits for your employees, vacation benefits, retirement benefits. They're accrued. They're accrued over time. Yep. Other accrued liabilities include things like taxes payable. Like, for example, let's say you have a retail business. Let's say you have a clothing line, okay? And you sell clothing on the internet or wholesale or whatever. And so with that clothing line, you're generating sales. Well, remember, you're selling something, and if you're selling something in D.C. or Maryland or Virginia or wherever, you have to pay sales taxes to those jurisdictions, right? So those sales taxes payable. That's an accrued liability. You build it up over time, and then every quarter you pay those taxes. Yep. The same with employee payroll taxes, right? You collect the taxes, from your employee, and you pay those to the various agencies. Yep. Those are all examples of accrued liabilities. And then we have unearned revenue, as I'd mentioned. That's when the company made a sale to a customer, but has not yet delivered the good or the service. Okay, that makes it unearned revenue. It becomes earned when the company provides the good or the service. Another example of unearned revenue that you're probably familiar with. If you've ever bought something on Amazon or eBay or whatever, and you notice that, hey, they didn't charge you right away. They didn't charge you until they shipped it. All right. So, like, for example, let's say you bought something on Amazon, you're like, hey, you know what? It didn't show up on my account. I don't know what's going on here. as soon as they ship it to you, that's when they charge you. That goes back to the unearned revenue rule. Okay, just so you know. And then we have the equity accounts. Owner's capital, that's capital that the owner invested into the business. This could include things like cash that the owner put into the business. It could also include things like the owner brought property, plant, and equipment into the business. Those all equal to what we call owner's capital, yeah, contributions to the business. Owner's withdrawal, that's when the owner takes money out of the company for whatever reason. They're paying themselves, they're using it for personal use, whatever the case is. We take it out of their capital, yeah, by withdrawal. And then we have revenue, that's from sales that the company made. And then we have expenses. Those are the day-to-day operating expenses of the business, things like rent expense, utilities expense, uh, repairs and maintenance expense, you name it. So laundry list of them. So with the accounting equation, as I'd mentioned earlier, it's expanded out, right? We have assets equals liabilities plus equity. Within equity, it's slightly expanded out. Equity is owner's capital minus owner's withdrawals plus revenue minus expenses, right? That's how we find the equity amount. I'll show you how it all works, but just want you to understand that that's the expanded version of the accounting equation. At the beginning, when we talked about analyzing transactions, we talked about the source documents and you know understanding the different accounts and how they affect the accounting equation. I also mentioned that we record the balances, and those balances are recorded to what we call the general ledger. The general ledger is based off of what we call the chart of accounts. The chart of accounts is a list of all of the different accounts that the company uses. And the list is organized by liquidity. Liquidity simply means how quickly something can be converted into cash. Okay, liquidity is how quickly something can be converted into cash. The chart of accounts is organized by what we call liquidity. That's why you'll always see that the assets area of the business starts with cash. That's always going to be the first account under assets. Cash, because it's cash is cash. Accounts receivables and usually the next one because it can be quickly converted into cash. Then supplies, also known as inventory, can be converted into cash quickly. Prepaid insurance, pretty quick, converted into cash. Equipment, it takes a little longer to sell equipment. But you'll notice that the assets are organized by liquidity, how quickly they can be converted into cash. And you'll also notice that there's a little number next to each account, and that number represents the account number. It's a unique identifying number that's associated with each account. And it helps you to keep things organized. Yeah. Liabilities start out with short-term liabilities like accounts payable, and then they move into long-term liabilities like notes payable and that type of thing. And then under equity, you'll always have the owner's capital, then the withdrawals, and then revenues and expenses. You'll notice that some companies will have more than one type of revenue. For example, Amazon. Amazon has multiple revenue streams. Okay? They have revenue from sales of products. Yeah. They also have revenue from services like cloud streaming services. Okay. They also have other forms of revenue like ad revenue, et cetera, et cetera. So they have multiple revenue lines. It's important to keep those broken out because you need to know where all of your revenue in the business is coming from. Yeah, helps you make better decisions. I know that some of you, you're mortuary science students, right? So some of you are mortuary science, some of you are hospitality, some of you are general business, some of you are in accounting. But it's important to know that there's a lot of different revenue streams. Even in your respective businesses, there's multiple revenue streams, and you'll notice that they're categorized by the type of revenue that it is. The reason for that is so you can better manage the business based off of those revenue amounts. And then we have the expenses. This includes things like salaries, insurance, rent, supplies, utilities, et cetera, et cetera. And they all have an associated number with them. So that's what we call the chart of accounts and the general ledger. Now that you have an understanding of the chart of accounts, you know what the different accounts are. Now let's do some analysis of the transactions. We've identified the source documents. We understand the organization of where different accounts are as they relate to the accounting equation. Now let's look at the individual transactions. We're going to analyze them and record them. Okay. We do this analyzation and recording through what we call double entry accounting. The term double entry accounting simply means that with every transaction, there is two or more accounts involved in that transaction. One account will have a debit balance and the other account will have a credit balance. That's what we mean by double entry accounting. There's two accounts for every single transaction, two or more. So we can visualize an individual account and its balance by looking at what we call a T account. Why is it called a T account? Because it's shaped like the letter T. Yeah. So we have the name of the account at the top, and then we have the debit balance or the credit balance. Okay. You'll notice that for every single account, debit is always on the left. Credit is always on the right. If you've ever looked at a bank statement, you'll notice debits and credits. Yeah. You'll notice that on the left side there's debits, on the right side there's credits. It's been this way for thousands of years. It's just a visual representation of the balance of the account. Yeah, if it's a debit or a credit. And when you think about this, I want you to think about it like this. It's either going to have a debit balance or a credit balance. Okay, it's not going to have both. It's not going to have both. It's either or. That's what we call the normal balance, which is this right here. Okay, so this just kind of helps you visualize and understand what the normal balances look like. For asset accounts like cash, accounts receivable, inventory, property, plant, and equipment, to increase the balance of an asset account like cash, we debit the cash that account. Okay, to increase an asset account like cash, we debit that account. When we debit an asset, we're increasing the balance of that asset. This includes things like cash. To decrease the balance of an asset account, we credit that asset account. Right? That's how you decrease an asset account, like cash, for example. You'll notice that normal balance flips to the other side when we talk about liabilities and equity. Why is that? As you've learned in basic mathematics, when you go to the other side of the equal sign, you're reversing the sign. Yeah. Same rule applies here. So here we have liabilities. Liabilities like accounts payable, notes payable, other payables, liabilities. We owe it. To decrease a liability account, we debit it. To increase a liability account, we credit it. Okay. This slide's so important because it helps you to visualize the balances that we normally have. And I'm going to show you what this looks like as we talk about the different types of transactions. And then the same for equity. To decrease equity, we debit. To increase equity, we credit. An example of this would be things like owner's contributions, owner's withdrawals, revenue, expenses. I mean, the revenue expenses actually gets a little bit more complicated. To increase revenue, we credit it. But when it comes to expenses, to increase an expense, we debit it. I'm going to show you what that looks like now. So, owner's contributions, to increase owner's contributions, we credit it. But when it comes to owner's withdrawals, to increase a withdrawal, which is a negative, we debit it. For revenue, to increase revenue, we credit it. To increase an expense, we debit it because it's negative. So I want you to think about that as we move through the transactions, and this slide is very, very helpful for understanding the normal balances of accounts. Okay, so here we have an example of a T account. As I mentioned, a T account is a visual representation of a single account, and it shows us the balance of that account. Cash is an asset account. And as we just learned, the normal balance of an asset account is going to be a debit balance. Debits are here on the left and credits are here on the right. What this T account shows us is a history of the transactions that have affected the cash account. On the left side, we see instances where cash is coming into the business for various reasons. We received an investment from the owner to get the business started. Okay, $30,000. We received consulting revenue, $4,200. We received cash from a customer from their account receivable, $1,900. Okay. We had those all up together to get $36,100 debit. Now, we also made some payments using cash. Yeah, because cash goes up and cash goes down. You know that. That's the same thing happens in your bank account. Cash goes down. Every time we reduce our cash, we credit our cash. And the business uses cash to pay a lot of different things. We purchased some supplies, inventory, $2,500. We purchased equipment, $26,000. We paid rent, $1,000. We paid salaries, $700. We paid accounts payable. We paid a bill, $900. The owner took some cash out, $200. We take the debit amount minus the credit amount to get the balance. Okay? In this case, the balance is positive, which it should be. And cash normally has a debit balance. That's why you see the balance on the left side, $4,800. This is, again, just a visual representation of the different transactions that have occurred that affect the cash account. Okay, now for the fun part. We're going to go through the process of analyzing and recording the transactions, and I'm going to show you what the overall impact is on those financial statements. The income statement, the balance sheet, the statement of cash flows, and the statement of retained earnings. Here we go. Buckle up. Okay. As I mentioned earlier, there's 4 steps. First step is to find the source documents. This includes things like the bank statement, purchase order, sales receipt, bill, service contract, etc. Source documents. When you find your source document, you find the information, the date, the amount, who it's for, whatever, whether it's a customer or a vendor or whatever. Once you've found the amount and the date, we use that information to analyze the transaction. Okay, so what two accounts or more is this transaction affecting? Is it affecting cash? It is affecting accounts payable? Is it affecting, whatever? To identify the accounts that the transaction affects. The third step is to record the transaction, record the entry. And we record that in what we call a journal entry. And those get posted to what we call the general journal, which is a list of all the transactions. That's the process. So we follow these 4 steps for every single transaction. A lot of times it's very obvious. If this is the transaction, here's the receipt, blah, blah, blah. And then you just enter it into your accounting information system, like QuickBooks or whatever. So when it comes time to record that transaction, there's a couple of pieces of information you need to know. Number 1 is the date that the transaction occurred. Okay, this is really important. The reason why the date is so important is because of the matching principle that we talked about last week. The matching principle tells us that we need to match our revenue and expenses in the same time period, okay, of when they were incurred. And the reason why the date's important is because that needs to happen in the same month, right? The expense was incurred in a certain month, and that expense needs to match the revenue. So that's matching principle. That's why the date's so important. So number 1, we find the date of the transaction, record the date. The second thing we do is we identify the accounts being affected. First, we record the debit account. The debits always come first, because remember, they're on the left side. Left comes before right. So left side, debit comes first. In this particular transaction, the owner of the company is contributing $30,000 of cash into the business. So we're debiting cash to increase cash. And then we record the amount, $30,000. Then we record the credit account and the balance. We credit owner's capital, right? Because the owner's contributing capital to the business to increase the equity for the owner. We credit the account. So we credit owner's capital, and the credit amount is $30,000. And then the last thing we do is record a note. Like what was the purpose of this transaction? Yeah, an explanation. You don't always have to do that. You'll notice that some companies don't do that. But if it's a transaction that's like important, I record a note. So sometimes letter D or fourth thing comes into play. And we do that same process for every single transaction. Yep. Those T accounts, yeah, they're super helpful to understand the transactions from a visual perspective. They help us to track things that have happened to that account. Here we see the cash transactions. That first transaction that we just saw, the owner contributed 30,000 into the business. So we recorded the date. 30,000 came into the business, December 1. We made some payments, 2,500, 26,000. 2,500 was, I think it was accounts payable. The 26,000 was a piece of machinery. We paid cash for those things, so we see the credit balance. And then we received accounts receivable from a customer. They paid us the 4,200. You can see what's happening in the balance on the right side. That same balance on the right side is updating with every transaction. And as it updates, it's updating the balance of cash. And as you know, cash is the first account under assets, which is on our balance sheet. So the balance sheet of the company shows the updated balance of those accounts. It's coming full circle. Yep. So as we are recording the transactions, so we post those to what we call the general ledger, which is a list of the transactions, as I had mentioned. The general ledger records those balances for each respective account based off of the transaction. So that's what this shows us. The first thing we do is we identify the debit account, and then we identify the credit account. We record those to the general ledgers. Again, it just updates those balances based off the transaction. That's what this awesome diagram shows us. So we follow those 4 steps to record transactions: identify the source documents, analyze the transaction, figuring out the accounts and how they impact the accounting equation. Then we record the entry, and then we post it to the T accounts or the ledger accounts. Okay, so here's our first example, our first transaction. Number 1, we received $30,000 in cash from the owner as an investment into the business. So we debit cash, 30,000 to increase cash. We credit owner's capital, 30,000. And then we post it to the ledger accounts. You see? So that's the first transaction. Second transaction, we purchased supplies using cash, inventory, using cash. So we debit supplies or inventory, 2,500. We credit cash, 2,500. Both of these are asset accounts. And then we post those to our ledger accounts. It's 4 steps, but it goes fast, right? Third transaction. Company purchased equipment using cash. We debit equipment to increase our equipment. It's an asset account. We credit cash to reduce our cash. Also an asset account. 26,000. And we post those to the general ledgers. We've increased equipment. We've decreased our cash. You'll notice that the cash, all 3 of the transactions that we just went through all impact cash in some way, and you'll notice that the balance is being updated for cash as time goes on. Fourth transaction, company purchased supplies, inventory on credit. Okay, So I debit supplies, 7,100, and I credit what's called accounts payable. When the company purchases something and we do it on what we call on credit, it means that we're purchasing it from our vendor, but we're not going to pay them right away. We'll pay them in 30 days. Okay, it's we do that on what's called credit terms. Yeah, it's an agreement that you and the vendor make. You say, "Hey, vendor, I'll pay you every 30 days. The balance." Okay, great. So that's what we call on credit. It's not a credit card. It's it's basically like you're purchasing on credit. You're saying, "Hey, I'm going to pay you later." So it's similar to a credit card, but it's not the same. Yeah. So that's why we post it to accounts payable for that vendor. So we debit supplies, credit, account payable, and then we post those to our ledgers. You'll see that supplies went up. Yeah. Accounts payable went up. Transaction 5. We provided services for cash. We, the company, provided services to our customer. Customer paid us in cash immediately. 4,200. We debit cash. 4,200. We credit consulting revenue. 4,200. Consulting revenue is an equity account because revenue is an equity account. And to increase revenue, we credit it. Yep. Transaction 6. We paid rent using cash. Okay? We debit rent expense, $1,000. Credit cash, $1,000. Rent expense is an equity account, and to increase an expense, we debit it. To decrease cash, we credit it. Another example of paying an expense in cash, we paid $700 to an employee for their work. We debit salaries expense and we credit cash, $700. We increased salaries expense by 700 and we decreased our cash by 700. Transaction 8, we provided consulting and revenue services on credit. Here's what this means. We told the customer, "Hey, we'll provide the service to you. You can pay us later." Okay, on credit. When you hear the words on credit, it usually either means accounts receivable or accounts payable, depending on what's happening. Okay? So on credit means accounts receivable. They're going to pay us later. So I debit accounts receivable, 1,900, to increase accounts receivable. And then I credit each respective revenue line. Okay, there's two types of revenue that happened. I provided consulting services for 1,600, and I also rented equipment to my customer for 300. You see, so it's important to record each respectively. So here I have 3 different accounts, but the debit and credit always equals. Mohammed, yes.
So I have a question, please.
Mhm.
Um, in the record schedule, um, what is this PR that's in the middle?
Mhm. PR.
Yeah, PR. That is 106, 403, 406 in the
Oh,
record
Professor, I
oh,
can
schedule.
answer
yeah.
this question for him.
Those are the numbers of the accounts.
The
Let's
numbers
see.
of the accounts.
Yeah. That's the account number from the chart of accounts. Those are the account numbers from the chart of accounts. It just helps us to track the because remember when we talked about the chart of accounts, when we talked about the chart of accounts, each I'll go back and I'll show you real quick on 31. When we talked about the chart of accounts, you'll notice that, and let me make this a little bit bigger. You'll notice that, and that's right here. Oh, sorry. That each account has a number next to it. And that helps us to track the respective account. Yeah. So that's what that PR means. It basically stands for the account number.
Okay. Yeah, I understand.
Cool. Great. Awesome. Very cool. So yeah, sorry. I should have mentioned that earlier. I apologize. Where were we? 31, right? Okay. Right, great. Let me just fix that. All right, cool. So yeah, that's what that means. It's a respective account number. Okay. Next transaction, number 9. Here we have we're receiving cash from an account receivable. That transaction from 8, that customer is now paying us. Okay. So a couple days went by, customer's paying us. We're receiving the $1,900 from the customer. We debit cash, $1,900. We credit accounts receivable, $1,900. Okay. Now we post them to the ledgers. You'll notice that, I'm increasing my cash $1,900 and I'm decreasing my account receivable by $1,900. It's important for you to understand that with accounts payable and accounts receivable, those are what we call contra flow accounts. Contra flow accounts. What that means is the account balance of accounts payables and receivables go up and down. Okay, they go up and down. And they go up and down based off of what's happening. Okay, for example, this customer, the one that we're looking at, in the earlier transaction, they purchased consulting and rental for $1,900 on account. Now they're paying us. So we, in this transaction 8, we increased the account receivable for that customer by $1,900. Then when the customer pays us, we reduce their account receivable by that amount that we received from them. You see? That's why we call it contra flow. It goes up and it goes down based on what's happening. Yep. Okay. Transaction 10, partial payment. Oftentimes, you're not going to pay the entire bill, okay, in business. Here's what I mean by that. Let's say you have a vendor and you receive the invoice, the bill from the vendor, and it has a whole lot of transactions from purchases that you made from them. Sometimes you're not going to pay the whole balance. You'll pay it partially. Okay, so here's how this works. We debit account payable by that amount, and we credit cash by that amount. We do it for that particular vendor. Transaction 11. Owner took out some cash from the business, $200. Debit, owner's withdrawals, $200. Credit cash, $200. Also as a ledger. Transaction 12. We receive cash for future services. When you see future services, that means we have not yet provided the service. Okay, that means unearned revenue. No worries. Thank you so much for being here. We're almost finished. So unearned revenue, we debit cash because the customer is paying us, but remember they're paying us up front for future services. So we credit unearned revenue. In this case, unearned consulting revenue by $3,000. Transaction 13. we're paying cash for future insurance coverage. Again, future insurance coverage. Just like the example I gave you when I paid the $1,200 for the year of insurance, we call that prepaid insurance. It's for the future. Debit, prepaid insurance, credit, cash. Purchase supplies for cash. Very simple. Debit supplies, increase supplies, credit cash, decrease the cash. Then post it. Payment of an expense in cash. In this case, utility bill, debit utilities expense, credit cash. For 305, post it. Payment of expense in cash. Debit the expense, credit cash. In this case, it's salaries, debit, salaries expense, and credit cash. Yes, of course, Maria. I post these all the time to both the YouTube channel and in the classroom. Absolutely. Here we see a summary of all of those transactions, and you'll notice what happened with the balances. They all updated as the time went forward, right? And so that's how that worked. Mohammed, did I see your hand up?
I'm sorry. I'm so sorry about this. I just raised my hand up by
That's
mistake.
okay. No worries. No worries. It's all good. So that's the recording of the transactions, and the last part I wanted to show you is the impact on the financial statements. How do we prepare the financial statements from the recording of all of those transactions, you might be wondering. So we have a list of all of the accounts and their balances based off of all of those transactions. We create what's called a trial balance. This is the first kind of unofficial statement that we prepare to balance our transactions. We compute the debit and credit amounts to make sure that they balance, and we verify that they balance. So it's the 3 steps. This is an example of what we call a trial balance. You'll notice that we list out every single account and the balance of those accounts. You'll notice that if we total up the debits, it equals 45,300, which equals all the total credits, 45,300. This helps me to verify that all of my balances are accurate. In accounting, it's so important that we try to look for errors and fix those errors if we identify them. So the first thing we do is verify that the balances are correct. We look at, make sure that debits and credits equal. If there's anything wrong, we do a recomputation. We verify that the journal entries are posted correctly, and then we post them. So here we can see the impact on the balance sheet, income statement, ending balance sheet, statement of retained earnings, statement of owner's equity. Statement of owner's equity and the statement of cash flows. You'll notice that on the income statement, we have revenue and expenses. Revenue minus expenses equals net income. We prepare income statements every month, every quarter, half year, and every year. A balance sheet represents the balance of all of the accounts at any given point in time. Okay, it could be a random day in the middle of a month. You could just check the balance, on the balance sheet. It should be accurate. Then we prepare the statement of owner's equity and the statement of cash flow. The income statement provides all of the revenue and expenses for the business, the day-to-day operations of the business, over a period of time. This would be a month, a quarter, half a year, or a year. The statement of owner's equity shows us changes in equity over time, owner's contributions minus owner's withdrawals, that kind of thing. The balance sheet shows us the balances of all of our asset accounts, liabilities accounts, and equity accounts. Thank you so much. And the statement of cash flow shows us cash coming into the business and out of the business for operating activities, investing activities, and financing activities. And we'll break more of those things down over the next few weeks. But this is an example of the income statement. You see our revenues at the top, always at the top, and our expenses at the bottom, always at the bottom. Total revenue minus total expenses equals what we call net income. Net income represents the income earned for that respective month. That net income amount gets transferred onto what we call the statement of owner's equity. Owner's investments plus net income minus owner's withdrawals equals ending owner's equity balance. That owner's equity balance gets transferred onto the balance sheet under equity. And of course, our balance sheet shows us all the balances for all of our asset accounts, liability accounts, and equity accounts. You'll notice that we didn't include any dollar signs or things like that. Most of the time, you're not going to see that. Because we imply an amount, not necessarily like a dollar value, things like that. The last two things I'm going to show you real quick are ratios. There are two ratios I want you to know. This first one is called the debt ratio. This helps us as investors, as business owners, to evaluate the level of risk for debt. And the way that we do that is we take total liabilities divided by total assets. Total liabilities divided by total assets. Both of these are found on your balance sheet. The higher this ratio indicates the greater probability that the company might not be able to repay its debt in the future. It's a good ratio to know. And then the last ratio I want you to know is a debt ratio. It's the same ratio, but this is an example. So we take total liabilities divided by total assets. For Costco, in the current year is 0.66. For Walmart, it's 0.64. Does that mean that Costco is a riskier investment than Walmart might be? Well, yeah, probably. Because remember, the higher this ratio, the riskier that business is. And that, my friends, is the end of our chapter 2. So I sincerely appreciate your time today. And just as a reminder, what you need to do for this week, by Thursday night, you should have your first initial discussion board post completed and responded to of your classmates by Sunday night. Please follow the instructions. You'll select 2 out of these 5 and use these bullet points to answer those, yeah? And then respond to 2 of your classmates. Should be about 100 to 150 words for each post. And then you also have the Chapter 2 quiz. Very similar to the Chapter 1 quiz. You have 2 attempts. Highest attempt is taken in the grade book. Again, if you have any questions, comments, or concerns, you can email me, call me, set up office hours. Whatever you need, I am always going to be here for you. And again, thank you so much for your time today. I appreciate all of you. And I'll see you again online next Tuesday. For this coming Thursday, I want you to use that class time to complete the work for this week. Thank you all so much for your time. Appreciate all of you. Have a wonderful rest of your night. Thank you so much. Take care. Bye-bye.